I worked with a guy who was buying a business, and I was recommending that he require like 30 or 40% seller financing for this deal. He ended up borrowing 90% SBA financing and putting a 10% down payment. So the seller got all cash on closing. And there was a traffic accident 2 weeks after closing where one of the key managers unfortunately passed away. So this is the power of the deal structure.
Neal Isaacs here with the Raleigh Business Broker Show, and I'm super excited to welcome back to the program David C. Barnett. David, how are you doing today?
I'm doing awesome, Neal. How are you? It's great to be back and great to see you again.
It's always fun to talk to you. I enjoy all of your content. I was on your program for the Listing to Legacy. I got to do your Christmas edition, Christmas Eve edition. What was that we
Yeah,
did?
Christmas Eve special.
The Christmas Eve special. If you're not following David C. Barnett, you're missing out. David's doing all kinds of fun things, consulting, and we speak a similar language when it comes to just what's happening in the SMB world. So today, I wanted to invite you back, David, to do a breakdown of, we're calling it the top 10 transaction troubles to Transverse. Are you excited?
That's a lot of alliteration. My high school English teacher would be very proud of me if she knew that I was doing something like this.
Well, we're going to transverse them together, and because these are important things. I mean, if you're going to do a deal, something's going to come up. So let's talk about it. My thing is, if things are going smoothly, if it's really quiet and there's no trouble, we're missing something. It's coming. Like, we just haven't discovered it yet. We can't close the deal until we get past that. So let's find it. I'm always trying to look around corners as an intermediary.
Yeah, a lot of people get into this and they don't really realize just how hard it is to do one of these deals. And I think that's where your feeling comes from, eh? Like that if there's not some kind of crisis, there must be something wrong. So, all right, well, let's go through these. We'll give our input on each of these.
Let's start with, we're going to go through 10. Let's go through number one. It's pretty simple. What happens when the money doesn't add up to the as advertised type of situation? So you're looking to buy a business, or you're selling a business. You're saying there's a cash flow of X. You go into contract, it's diligence time. What happens when things don't add up? Have you ever seen this happen, David?
I have, but more often than that, I see an advertised cash flow that isn't there even before the offer. So people will advertise a certain cash flow, then they'll get their hands on the SIM or the business profile, and in that business profile is not the same numbers as what was advertised. So
Yeah.
I always tell people actually not to put any consideration at all into, what is advertised as far as cash flow, but rather simply to look at the sales level because that's really hard to mess up,
Yeah.
and the industry. So if you know you're looking for businesses in a certain industry of a certain size, just you can approach the ads that sort of meet that criteria and then deal with, the cash flow that's actually there once you get more documentation in front of you. Um, you know, when you make an offer, it's based on the information you have. And so if you find out during due diligence that the cash flow isn't the same, well, then obviously you need to amend your offer. And it's surprising when brokers or sellers seem offended or put off when people want to amend their offer, because obviously the buyer is making an offer based on the information they had at the time.
I like what you're saying, and getting into this a little deeper. Obviously, I represent sellers, so I'm typically the one that's doing the advertising, and you play different roles in different transactions depending on what people hire you for, or kind of how you're advising. And we're real careful about what we advertise. But what I heard you say is gross revenue is the easiest thing to measure. So start with that.
Yeah, I mean, if you know that in a given industry that you need a business that's got like $2 or $3 million of revenue at least to make you happy, then that's the number you really should be looking at, just to make sure it's big enough.
I should point out that even the word cash flow is loaded, and that business brokers like me, we have words like SDE, seller's discretionary earnings, EBITDA, and all that could be considered cash flow. It's an earnings stream or owner's benefit. Even owner's benefit isn't accurate, because EBITDA is not the owner's benefit. It's the business, what the business throws off. So, yeah, I think the lesson would be, to your point, take it with a grain of salt. Focus on what you can measure, and gross revenues should be pretty verifiable through bank statements. This is a diligence question, number one, that we're working on, right? So to have a good diligence approach, and by the way, what you said also about it's the earnings times the multiple. I find that savvy buyers will ask me, the broker or the seller, how did you guys value this? And we'll say, we multiplied the cash flow times the appropriate multiple. The savvy buyers will say that, and then they'll use our own logic to say, well, based on that, well, if the cash flow wasn't what you said, then it's a logical conclusion in that scenario.
So it's interesting that you bring that up because I coach my buyers to not get into that conversation. And the reason is because if you get into a what I've seen over the years is if you get into a conversation about the methodology, then it's easy for
Yeah,
people to start to argue over the methodology. And I often have this problem when I'm working with buyers who happen to be engineers for some reason, because in engineering there is a correct answer. You know, if you say how thick does the
yeah,
steel need to be to build this bridge, like the engineer can do the math and tell you, and they'll try to apply that to the negotiations to buy a business, and they'll get frustrated when their logic says the business is worth this amount and they can't get the other party to see that. And the way that I often coach buyers to frame it is to not worry about how the seller came up with the price. You have to figure out what works for you, and then you can make an offer based on what you need and what your position is and what your equity is going to be, et cetera, and say this is the deal that works for me. Because then it's like someone saying I feel whatever. Like you can't argue with someone about their feelings, and so you can't argue with someone about what works for them. So I caution people not to get into the nitty gritty of the methodology, just because it can lead to confrontation. And in my experience, you want to be as collaborative as you can be when you're talking, with a seller. Selling a business is hard. It's a difficult task that people have to work together to solve. I think that's the mindset that I like to encourage.
yeah, and we're overcoming transaction troubles. I can already see a theme is going to emerge here, and it's think about the fact that there's a human on the other side of the deal, and that you
Yeah,
make a valid point. Let's not get bogged down in the methodology. It's almost like it's a gotcha moment. I gotcha. This was your formula, so I'm going to tweak your formula. But I like your approach of this is the offer that works for me, and is it the good fit for you too? Because if so, let's move forward. If not, then I'll look at other deals. That works too.
yeah.
Let's stay on this because number two is a similar diligence type of thing, and it's a little bit of alliteration here. It's double counting the distributions.
Hmm.
So what we see a lot sometimes, often when owners do their own valuation, is they say, well, I know I paid myself $50,000 in wages, but I also took $50,000 out. I just wrote myself a check. I took a distribution. So simplified world, this business makes $100,000, and then maybe they add a multiple on top of that. Is that right? The right way to do it, David?
So distributions or dividends, that's a balance sheet activity. It's not an income statement or P&L activity. So when a business, if a business is paying someone paying the owner a wage, like a W-2 salary, that's going to appear on the P&L as an expense. And then there's going to be some profit down below. And that net income at the bottom of the P&L is usually where people start to create their seller's discretionary earnings. But that profit is the cash that the distribution comes from. So if you add
Yes.
your distribution as well, you've just counted the same money twice. Again, this is a common mistake, but I've seen brokers make the mistake too. And where they'll make the mistake is they'll be employing a methodology to create the seller's discretionary earnings. They'll start with that net income number, and then they'll ask the seller, what money did you take from the business, and they don't clarify, and maybe the broker themselves don't quite understand the accounting behind it. It is something that's going to be discovered in due diligence, hopefully, because what will end up happening is you will see that the cash just isn't there,
Yeah.
and there's no way to follow it. And then you come back and say, hey, there's supposed to be this amount of cash, where did it go? I don't i don't see it still in the company bank account. I don't see that it left in the form of a check. Like, part of the money is missing, and it will be seen. The biggest hazard in this scenario is the sellers will see that higher SDE number, and then they'll be told their business is worth a multiple of that. And then, so maybe that means their business is going to be worth $1 million. And then you meet a buyer, you make an offer, you negotiate the offer, you get into due diligence, you discover the error, And then you come
Yeah.
back and say, your SDE is now this actual amount, so your business is only worth 600 grand. And the seller now has to deal with the loss of 400 grand of value, which was never there except in their own
Yeah.
imagination.
Yeah.
But I've learned over the years that people have to mourn that loss, much like if you lost a treasured possession. Like, the- people are very reticent to say, "Oh, sorry, it was a mistake. I'm not a millionaire business owner. It's only worth 600 grand." Um,
Yeah.
Sometimes we get business sellers who only chose to put their business on the market because of that value. And when
Yeah.
they find out it's worth less, they then have to retreat from the market because the amount of money that they're going to get isn't going to be enough to satisfy their need, retirement or whatever. That's the danger. It becomes a big waste of everybody's time.
This is kind of a diligence one too, and doing some pre-diligence before you go to market, making sure you know the right value could
Hmm.
avoid this transaction trouble. But yeah, we do see that a lot. You know, we're pretty careful not to do this double counting, but we see it with business owners that do their own valuation or business owners that have other people advising them and just maybe they haven't done this before. But yeah, it can really lead to some disappointment. It's not the buyer's fault. It may not even be the seller's fault, but this does happen a lot. So let's avoid this very avoidable transaction trouble. Getting the numbers wrong. It's very similar to number one.
Mm.
Well, let's push forward. How about I'm calling this asset titling issues. And what I'm thinking about, what I see often is, hey, what's the buyer getting? A lot of times owners they've got their personal vehicle and they're using it in the company, or um, things just aren't in the right entity. They're not in the right places when large assets are put into the business. They are either left out or they're left in or they're titled to a partner that's gone. Have you ever seen these type of issues?
Yeah, I haven't. And you know, it's got to be sorted out because when the seller puts the business up for sale, there's some kind of sim that should include. And again,
Yeah,
this is an issue I have with some brokers, but the sim should include, like, this is what you get for your money. Like, here's a list of the assets. Now, when you represent it that way, and then it turns out during at the very end, when the lawyers are involved and people are looking at things like titles, it turns out that
yeah,
something's not in the right entity. Well, then the seller's got to sort that out. And it could very well mean that, maybe the transaction has to be changed or the seller has to move an asset into their business or out of their business or
yes,
whatever. And it could trigger some kind of tax problem for them. They may have to, just realize a capital gain or something when they're moving an asset. But where it
yeah,
also comes into play, where it's sometimes just kind of smoothed over with no real comment, is on certain kinds of intellectual property things. So the business owns a website. Well, you assume that the website is registered in the name of the business, but it turns out it's not. It's, registered
yeah,
in the name of the owner or the IT person that used to work here 5 years ago. And a lot of the times, as long as the seller can kind of make the maneuvers required to get everything over to your name as the buyer, people don't really care because they
yeah.
received what they got. Um, and now, does that create some kind of liability for the seller? Should there have been some kind of recognition of the value of that IP moving from a person to the business before it was sold to the buyer? Like, I don't know. I mean, the IRS just lost a whole bunch of employees. Maybe people don't have to worry about audits anymore.
No, I love where you're going with this, and these are the types of things that come up towards the end. As much as we try to get through diligence and to sort out all the bag of badgers that is selling a business, these things inevitably come up when all the I's are getting dotted and the T's are getting
Yeah,
crossed. And you gotta that's why closings can be stressful because you can only diligence so far, and then you find out once you're trying to close the deal. And to your point, there could be tax repercussions. It could just be a pain in the butt, but you got to get through all this stuff. It's just diligence that doesn't actually stop when diligence closes. It stops when the deal's done, hopefully.
yeah,
Um, but you got to get through that stuff. And yeah, I was thinking about heavy assets, but I like how you were talking about more of the soft intangible assets. Those can have titling issues too.
yeah.
And speaking, we're not that far with number four. It's UCC filings. Well, that's what we call them here in the states and where
Mm.
I'm at. And they call it something different in Canada, eh?
Yeah, we do. We call them PPSA filings. So it's the
Yeah,
same thing. But what happens, I think, a lot all over the world whenever there's a registry of some kind for debts that's available publicly is that when a lender makes a loan, they're very quick to make the registration, right? Because they want to
yeah,
make sure that everybody knows that they are owed money. This thing is collateral. But when loans get paid off, it can sometimes be quite lackadaisical in the processes. And so, one of the things that used to happen here where I live in New Brunswick is when you paid off a mortgage on a house, the bank would send you the discharge documents, and it was up to you to take them down to the government office to register them. And of course, most people didn't. They put them in a box somewhere. And then
yeah,
when they went to sell their house, they ended up paying fees to get these letters reissued and stuff.
yeah.
And they changed that in the last few years. But I see it all the time. In fact, I had a client the other day where a buyer's lawyer looked up the company's name for UCC filings, found all these registrations for loans, and the buyer started to be freaked out. And I said, "Don't be freaked out. They're probably these loans that they told you were paid are likely paid. Just the
Yeah.
registrations were never removed." And so, but again, this can delay closings because lawyers are going to have to make inquiries, get paperwork submitted, and then change these, uh, go into
Yep.
the registries and record these things as being paid.
We see this holding up closings sometimes as well. And one thing that always perplexes us, and as intermediaries, we're trying to work with the transaction team and let them do their job, but make sure certain things are getting done. We've noticed a lot of attorneys wait till the last couple weeks to do the UCC filing searches. And I don't know why. I think that a lot of times they're like, well, let's let them go through diligence. I think they're doing it to say, let's not spend the money. I don't want to spend the client's money if they're not even going to get through diligence, which is
Yeah.
noble because they're trying to be prudent with their costs. But we're like, why didn't we do this earlier? Because we're trying to close now. So getting in front of searching for UCC filings, or what did you call them?
PPSA is what they're called in Canada.
Whatever they're called in your neck of the woods. Because to your point, David, it's not nefarious. A lot of sellers have paid off their loans and it just didn't get undone. And so this is definitely an avoidable transaction trouble, a common transaction trouble, and you just gotta. It's part of the paperwork of getting deals done that causes. It's just one of those back nine things that comes up, and you just got to push through it.
Yeah, and
Well,
I think most lawyers probably outsource this to
yeah,
people that do this all day long. And I think to your point about the
yeah.
cost, I think that's exactly it. They kind of wait until they get the all green from their client to then say, "Okay, now let's do this," because they don't want to incur the cost before they know it's headed to closing.
Well, we still haven't left diligence, but I think we're getting close now. UCC filings would be. I like to put diligence into financial, human resources, legal. I think that was more of a legal diligence. Like, do you have the right to sell this? Does everything
Hmm.
accounted for? The next one is deal fatigue, and this is we're done with diligence. We're just people get sick of working on these deals. They think it's going to be a quick exchange of keys for cash, and then they're like several months into a deal, and they're like, when's this going to end? And I've found that deal fatigue can really, really hamper a deal.
You know what I when I'm working with people that want to sell a business, I give them this as a heads up. I say, look, it's hard to sell a business. It can be hard to
Yeah,
find a buyer. And I'll tell them when you get an offer on your business that you accept, it's like winning the lottery. And people kind of
yeah,
smile because they're thinking about the money. And then I'll say, and when the deal closes, it's like winning the lottery again. And to
yeah,
try
yeah,
to drive home just the potential unlikeliness of the closing happening. Because
yeah,
there have been so many times in my career where I've had clients, buyers and sellers successfully agree to a deal and it never
yeah,
closes. Just
yeah.
because 101 things happen. And I want to prepare people for the understanding that it is going to be laborious, tiresome, potentially with lots of ups and downs emotionally as they move through all those things from the time they have a deal until closing. As you know, there's 101 things that can go wrong.
I agree. And I tell you one thing that we've implemented in our practice that I think makes a huge difference with deal fatigue. This is for sellers mainly, is the owner interview. And I don't know if you're seeing these in Sims, it's becoming more popular. It's kind of weird for the owner. What I've learned is to do one buyer owner meeting. So we'll put the owner with the buyer and do a one on one. and let them understand what the buyer's going to ask and hear it from a buyer. Because you mentioned the SIM, the confidential information memorandum, we'll put that together. But every SIM says this owner is retiring for ABC. The buyers don't believe that. They got to hear it from the owner. Even if they're 92 years old and they say they're retiring, they won't believe that if it's written on paper. They want to hear it from the owner. So I have found that recording a buyer owner interview, more specifically after if the first buyer doesn't buy, instead of doing the next 10 buyers, that's what causes deal fatigue. Hopefully, we don't do 10 buyer owner interviews. But if I can get a really good interview with the owner after they've met with a buyer and they kind of get how this works, we'll start getting offers from buyers. And we'll say, do you have any more questions for the owner? And they'll say, I kind of feel like I know them. I watched your interview with them. I
Yeah.
heard them say why they're selling. It all makes sense. I'm ready to make an offer. That can just jump us right past a lot of the laborious part of all these meetings. It's the meetings that really get to people, especially if you haven't gotten to the offer stage. The offer stage opens up new things. But to your point, that's like winning when they have an offer that's accepted. And the buy owner video I found is pretty helpful to help with that part of deal fatigue.
I think it's very valuable. It can put the buyer at a disadvantage though. And here's why.
Okay.
Because the buyer, in addition to learning about the business, the buyer needs to have an opportunity to give an impression of themselves to the seller, especially if the buyer
Good
is going
point.
to ask the seller for some kind of terms that, like, oh, I want you to seller finance more of the deal or something like that.
Yeah.
A seller who doesn't really know the buyer or feels like the buyer's a stranger is going to be far less likely to agree to anything like that.
Yep.
So the
Yeah.
buyer still needs to have an opportunity to make an impression on the seller and show them that they're a qualified candidate and that they're going to do great in the position. I sometimes deal with buyers who are really frustrated because they'll get involved with a broker and a seller who, for some reason, just won't grant access to the seller. And
Yeah.
it's very, I think a lot of these people may be real estate people trying to do business deals,
Sure.
and they're trying to keep the two parties apart. Um, but there's
Yeah.
got to be a relationship at some point that evolves. I think the value though in what you're talking about specifically is that buyers who for some reason are not good fits are going to be able to disqualify themselves earlier before
Agreed.
they engage and spend time with the seller. And so I think it's going to give the effect you're looking for, where it kind of expedites
The
both
filter.
the relationship, but also the deflection of improper
Yeah.
candidates.
And that's a valid point, David. And I can think of some scenarios where we've had buyers say, I want to meet the owner from his video or her video. I want to ask him more about A, B, and C. And as an intermediary, we're testing the buyer. Then they ask to meet the owner. We say, what are you going to ask the owner that we haven't already answered? Because by the time they get to that stage, they've watched a video, they've gone through a sim. If they ask something that's in there, I'm like, back to square one. Like the owner's time is valuable. Think of something we haven't already answered, and I'll give you that time. I'm testing them because I know that everybody wants to talk to the owner. We want to preserve that time back to the deal fatigue, to the people that have already consumed the materials. And if they have more questions after that, that's probably a really good buyer. And actually, number 6 is an interesting one, and it's the buyer and the owner spending too much time together. So this is the opposite of what we're just talking about. I was talking about keeping them apart until the right time. Now we're talking about, maybe you've seen this. We see this where, I can think of several scenarios where we found the buyer inside. They hired us to go to market. We went to market, and then we found out that it's a vendor, maybe an employee that they never thought could buy it, but we're finding the money. And now we're trying to get the deal done, and they're talking every day, and the broker's not there, and they're spending too much time together. Have you ever seen this happen?
I've seen it a couple times. Yeah. And they can get themselves sidetracked and they can kind of run around in circles and uh, yeah, I know. I've seen it.
I'm not saying it's always bad, but the times I've seen it, again, I understand that deals get done without brokers. But when I see it be a problem is we've got processes. We talked about how important, it's a little frustrating when lawyers do their thing, but they're trying to do the thing to protect the buyer and the owner after the deal. I had a buyer and owner where the buyer worked for the owner, and together they decided they were just going to go to the Secretary of State and do some filings themselves and save some time and money. It messed the deal totally up. And it's because they were just sitting there all day talking about, when are we going to close this? Why is this our transaction teams taking so long? Why don't we just do some of this stuff ourselves? So they were trying to help, but they totally mess things up. And I've
Well,
seen it. I've seen them turn against each other too, just because they're talking all the time.
one of the things that makes buying and selling of businesses so interesting is that it is a very um, opaque market. There's not a lot
Yeah,
of transparency. There's not a lot of visibility. There's not a lot of rules. People can kind of do different things. And what that does is it creates an opportunity for all kinds of stuff to happen. And
yeah,
it makes it difficult for people to find opportunity. And it's the people who have to, who are willing to roll up their sleeves and do the work to actually make the deals happen are the ones that are going to be able to go out and find things and invest in them. If it was
yeah,
as easy as I don't know, like the used car market, where people just put cars up for sale online and buyers were easily able to see the market and what other cars were selling for, it'd be a much more fluid market. I don't think it would have the same degree of opportunity. When people engage with professionals like brokers and attorneys to help them do the deals and then don't take their advice and don't do what they're doing, um, that's just a function of this. It's a function of this kind of market. And
yeah,
individual outcomes may not be ideal for those people, and they could be creating opportunities for other people when they're
yeah,
doing that kind of thing. Um, I think that it really just gets back to the mentality and the mindset of the people that you're working with. I've seen before where buyers are trying to follow an ideal process. They'll meet a seller who wants to be very informal. And to your point, we'll suggest something like that, like, oh, do we really need all these lawyers? Let's just sign it up on a piece of paper ourselves and get this deal done.
yeah,
And and in a way, it's kind of a trap. There could be potential problems that may arise. And not saying the seller is trying to trap anyone, but
yeah,
neither of them foresees the possibilities of what could happen. And that, I mean, that's the job like of an attorney, for example, is to like foresee how things can go wrong and try to put some
mhm,
guardrails on things through the documentation and create solutions for these potential outcomes. Um,
yeah,
there's just a group of people out there that does not want to take advice, call them uncoachable people, for example.
yeah,
It's
yeah.
just part of the landscape, and it's
That's
what
true.
adds to the opacity or non-transparency of this market.
It's a weird little business, the business brokerage market. It's in some states it's regulated by the real estate license, and in my state it's not under the purview of the real estate commission. So it varies by where you are.
Do you think that's an advantage or not? I almost think it's a disadvantage because in states where it's
Okay.
regulated under real estate, what
Yeah.
ends up happening is you get real estate agents who figure that because they have the license, they're qualified.
Oh, I was going to go a different way. I was going
Okay.
to say it raises the bar, so that, well, there's more buyer. Well, this is a whole nother show that I spent a lot of time on real estate versus business brokerage licensing, and with the IBBA actually, there's some stuff content there as well. But on the one, I could see where you're saying that real estate brokers could enter the business brokerage market and apply what's going on with NAR. Like, not that it's bad, but there's some of that could come into it. But on the other side of that is maybe it raises the bar for business brokers, and you get more of a more mature market of brokerage that has equal sides of representation. So this topic's been debated a lot. And let's do another content piece on that. I think that would be fun to go deep on
Sure.
that. Well, how about this? So, that was we're talking about buyers and owners spending too much time together. And to button that one up, what we typically say is, hey, congratulations, you just found a buyer and you know who the buyer is. I'm going to help you preserve the relationship. Let us be the buffer between your employee and your business buyer, because that's going to get really awkward to know who's in trouble. Let me manage the business. You guys talk about the day-to-day operations, and if there's any conversations about this deal, let's both agree that Neal's going to be involved. That's, I mean, we found that's the way to do it. It doesn't always work, but we have had trouble when the buyer and owner just sitting there talking all day without the broker. Things sometimes go south. But on this topic, number 7 is when key employees quit. We're
Mm.
talking about transaction troubles, and we have seen this. Now, in an intermediary model, our suggestion is to keep the sale confidential until the deal is done. It's super uncomfortable for business owners. Our position is you're doing your employees a favor and you're doing the buyer a favor. As uncomfortable as it is, if you just tell the employees, hey, This person over here is going to be your boss in a month. And then now they're worried about their job. They don't know who that person is. It causes all kinds of stress. But sometimes owners just tell their employees because they feel like they need to. They feel like it's the right thing to do. We can't control that. We don't recommend it. But then sometimes people quit, and then you're in a situation where the buyer's like, "Wait, what am I buying again? Like I'm really excited about this team. I got to go and buy a new business. I got to go hire new people." Have you ever seen this type of thing happen, David?
I think one of the things that prudent buyers always have to be thinking about is that we don't own people. Like,
Yeah.
we talk about how people are, important assets in a business, and it's true, but all employees eventually will leave a business, even if
Yeah.
they stay till the day they retire, right? And
Yeah.
so one of the things that buyers need to look at when they're looking at a business is they need to look at the level of documentation and process, et cetera, and what the labor market is like and how easily it would be to hire or replace someone, and if the processes and tools are there to help onboard someone new. Because it doesn't matter if it's the day after the sale happens or a year after, there are going to be people that leave the business.
Yeah.
And when you don't see that documentation there, when you don't see those tools there, this is got to be part of the way that you do your transition with your seller,
Yeah.
because you need to be able to engage with that seller to get their help if something like this should happen. This is one of the reasons why I'm a big fan of material amounts of seller financing. You need the seller to have an interest in the success of the buyer. And I'll give you a quick example. I worked with a guy who was buying a business on the West Coast, and in looking at the deal, I said, no, here's the kind of offer you should make. And I was recommending that he require like 30 or 40% seller financing for this deal. It was a highly technical industry, a couple of key employees. He felt that he didn't have the power to stick to his guns in that kind of offer. He ended up borrowing 90% SBA financing and putting a 10% down payment. So the seller got all cash on closing. And there was a traffic accident 2 weeks after closing where one of the key managers unfortunately passed away.
Wow.
And the buyer looked to the seller for help, and the seller didn't help him. Like the seller was
Wow.
like, no, it's yours now. You're on your own. And I don't necessarily think that would have been the case if the seller was still owed 30 or 40% of the money. And so this is the power of the deal structure. And
Hmm.
it's, you know, if you see some businesses that have a lot of personal goodwill tied up with the seller, you will see transition deals where like that seller is tied in with the business for an extended period of
Yeah.
time to help make sure that the customer goodwill transfers over. Well, if those tools and processes aren't documented properly and you don't have the ability to, like, you should be able to ask a seller, show me what tools you would use to onboard a new manager if this person quit,
Yeah.
and they
Yeah.
should be able to show you, here's our company wiki, or here's our playbook, or here's, our job descriptions or our org chart with our responsibilities detailed. And here's where, the workflows are, or how we make decisions, or any of that kind of stuff. Or even, if the key manager, for example, is in charge of advertising, here are the shared folders in our company drive that have all of our relationships for advertising and all of our ads over the years. And you can go right in here and see all the radio ads that we've done over the last decade, right? Like,
Yeah.
you want to see that they're organized. If all of that stuff I just mentioned is like on that individual's personal hard drive of their laptop,
Yeah.
that's not a well structured information system within that company, right?
Yeah.
And that kind of thing is often, buyers aren't even thinking about that stuff. But
Yeah.
that is what you need to be thinking about, especially if you're buying a business where there are some really like key high functioning individual people within that business that could be difficult to replace. I remember once I was helping someone with a moldings business. So they would create door trims and window trims and these kinds of moldings out of wood,
Yeah.
and they had a very
Hmm.
expensive CNC machine that would do this work. And the buyers were always concerned, if that guy who operates the machine quits, how do I find a new person? And the seller had a great answer, and the local community college had a wood products value added program that they were doing at the college. And they actually sent students throughout the year as part of their co op program to work with the person to work on that machine. And so the seller was able to say, like, there's 3 or 4 students every year graduating from the community college who've used the machine. And so you would actually have a labor pool available if you ever had to replace that person. And as sellers, that's the kind of question you should be prepared to answer. And as a seller, if you have that kind of person in your business who has this detailed key knowledge, you should be worried about it yourself. What do I do
Yeah,
if that person quits? Right? It's all about the
yeah.
ability to be able to step back.
You're speaking my language, David. I call it the 3 Ps: people, processes, and profit. And you're squarely in the people business and the processes part. And I can think of some great businesses that I've sold that had exactly what you're talking about. Here's how we hire people. Here's our pipeline of candidates. Don't worry about Cheryl. I mean, she's great, but if we don't have her, here's several other people that this is how we get the next Cheryl, whoever their manager is. So to avoid that transaction trouble, document, plan ahead. Good exit planning is good business. That's a SEPA slogan, and you just articulated that so well. So I think we solved that one. Key employee quitting, we got a solution. The challenge is you got to do some homework up front.
Yeah.
All right, we got just a few more left here. That one could have been a diligence one too. That could HR. That's an HR diligence thing. The employees quit and gets the key personnel. But the next one is back on the seller. Number 8, seller gets cold feet. This is a tough transaction trouble to get through. And I think this ties back a little bit to the deal fatigue, but this is a tough one. If it happens at the end, I can account for some sleepless nights from the seller getting cold feet. Have you ever seen this happen?
Yeah, it happens. And it ties into that whole, if you get the deal done, you've won the lottery twice in a row. I mean, there's
Yeah,
101 different things that can happen. And, um, you know, unfortunately, you can't, I don't believe, you can't enforce a contract to sell a business. Like
yeah.
think about it. What would happen if you tried? Like you're going to sue someone and make them sell you their business? Like, I mean, they could just
I know.
start
It's
doing
called a
things that
hostile
would,
takeover.
well, they could do things that would torpedo its value. I mean, they could do things that would
Yeah.
make the transition impossible. And so it's not really something that's doable. Um, I I have seen this kind of scenario happen a few times, and often the forces that led the seller to put the business up for sale will reassert themselves. And sometimes it's just a matter of having a little break or giving them some time or space. But you've got to have a willing seller who wants to do a deal. I don't see how you could put something like this together without that because you need the seller in the transition. And so it's personal stuff, it's personality stuff,
It's
it's
an
dealing with
emotional one.
people.
This is an emotional one. And one thing that you don't know until you're in the middle of it is that seller motivation tends to move a lot. I had a guy that wanted to sell and he had heart issues, and you catch him on a good day and he'd be like, I don't know why I would sell this thing. I make so much money, and and I feel great. And then you meet him on another day, and he's like, "Oh my gosh, I only have a few days left to live. Why am I in this business? I don't care about the money." And then he goes to the doctor, and he's back up again. So that's an extreme version, but seller motivation depends on the day of the week. And if you get to a hard part of the deal, sometimes the seller can get cold feet. And to your point, maybe they just need a little bit of time. Back to our earlier discussion, I think it was point number 1, that this is the people business. There's a lot of numbers and stuff, and we're getting through a deal, but we're also dealing with humans.
There was
Um,
a case early in my career where a seller was quite old, in his 80s,
yeah,
and and really his whole identity had been tied up in the business. And he got cold feet at the end because he really didn't see what he was going to do with himself. And the buyer and seller, had met several times, and the buyer ultimately made the offer that if once the deal had closed, the seller could keep his office.
yeah, I love that.
So I mean, he didn't have a job, but he would come in the morning and he would make coffee and talk to some of the employees and some of the
Yeah,
customers, and then he would like go home and have a walk or take a nap.
that's a
And
great
he
solution.
would stop like so there can be things that can happen to make
Yeah,
someone comfortable with it, but you've got to discover those things. And you only
yeah.
discover those things through really getting to know the other party and what it is that's motivating them to want to do the deal.
Well, I've got a solution or a suggestion for this transaction trouble. And and for us, again, intermediary, we're running deals. We have mandatory buyer owner meetings every week. The deal could take months. We're gonna get together. It's gonna be on the calendar. And we're gonna look at each other. And if we don't have anything to talk about, we're just gonna ask how our day went. Usually there's something to talk about, but what we have found are the deals that we feel like everything's cool, so let's not meet. There's this drifting that
Yep.
happens, and it's harder to get past these issues. And if you meet every week, you're going to know how the seller's feeling, and if something is starting, if they're changing, if they're just not all there. And I think this, we call it a cadence. I think this cadence of meeting really helps with avoiding these surprises or the drifting of the seller motivation. So that's a recommendation I have for anybody who's trying to get a deal done. Meet every week, work on business, and check in with each other. I
I
think
think
that
it's a
can
great
help to
idea.
avoid. Okay, we got two more. Number 9 is last minute concessions, concession requests, specifically from, usually from the buyer, could be from the seller. This could be painful. This could be a real transaction trouble. You're almost at the finish line. You need something from the other side, and the other side's starting to turn the screws a little bit. This is where it can be really stressful. People ask me how I like being a business broker. I say it depends on what day. And if it's one of these days where we think we're going to close, but one of the parties is making last minute concessions, it's not a good day to be a business broker.
Mm.
Have you seen this happen in deals you've advised on?
Yeah, and it's a bully tactic,
It is.
right?
Yeah.
You're
Yeah.
you're waiting for yourself to get into a position where you have more leverage over the other party and you're trying to take advantage of them. And
Yeah.
so my advice to the party that is receiving these requests is, what does this information about this behavior indicate about the character of the person you're doing business with? And what will the long-term fallout be from having done a deal with a person of this character?
Mhm.
Because
Yeah.
if you are getting into something where you have some kind of tie-in, like if there's a seller note or some kind of transition period or something where you need to have a relationship with this person, and now you're getting an idea of their true character and what they are like,
Hmm.
does it change your mind about wanting to do business with them? And you know, there can be a lot of motivation or pressure to do a deal because of things that are happening in your life. As a seller, for example, you want to retire,
Yeah.
there's family concerns or something like that. But you don't want to end up torturing yourself by getting into a deal with someone who is going to behave in this way. Getting into a position where there's these last minute concession requests, I think there are often warning flags earlier that people
Yeah.
ignore because they want to do a deal. And
Yeah.
this is just another manifestation of some of these negative or undesirable character traits. And like I've said to so many people over the years, if it doesn't feel right in your gut, listen to your gut.
Yeah.
Like, all business is done between people, and you have to have a working, trustful relationship with this person to get the deal done and get through the transition. And, or if you're a seller, to ultimately get paid, all the money that you're due if there's a seller note. And
Yeah.
you got to do business with people you jive with.
Well said. And this is our central thesis. You're doing deals with people. I love what you said about you feel it in your gut. Yeah, I would say if you interviewed the people that had these last minute concession requests, they would say I wasn't surprised because the way things were going, these shenanigans. I'd
It,
seen something like this earlier and I ignored it.
well, now, if it's a concession request because of a new piece of information, that's different.
That's
But
different. Yeah, that's
but if it's
different.
just someone trying to be a bully, that's what I was
Yeah.
getting at.
No, no, that's true. And I can think of some situations where it was a tactic. The buyer, if it's a buyer, they kind of knew they were holding this on to the end, and it is insidious to let an owner think they've got the deal that they want, and to let them taste that. Oh, we're going to close next week, and then to throw this. Well, we're not going to close unless I get this.
Listen,
That's
this is
like premeditated.
this
I've
is a
seen.
this is a playbook taught by some nefarious characters online,
Yeah.
where they will actually advise buyers to go and make a full price offer and lock up the seller into an exclusive period, and then
Hmm.
go. I've seen checklists people have created to get, and they were giving out to buyers saying, "This is how you go and find all the little things that you're going to come and later retrade with."
Well,
And
that's yeah.
so this the whole bully thing happens on the buyer side as well.
Well, a tougher one to avoid. Knowing is half the battle. We've talked about it. If you're a business owner, be analytical, and preparation can help with a lot of this. Those weekly meetings we talked about, the diligence we talked about earlier. A lot of this, the great deals that we do, it's kind of smooth sailing, and there's not a lot of surprises at the end, and that comes from a lot of work up front. Um, okay, well, let's move on. The last one, I don't know if I saved the best for last, but it's a transaction trouble that we worry about in every deal.
Yep.
It's landlord issues. And I'll say this, every owner that we talk to in our first conversation that says, I got the best landlord ever. They never give me any trouble. I say, okay, well, you've never sold your business before. They like you because you pay rent. And when you tell them you're going to move on and someone else is going to be there, that's when we're going to really learn, like, if they're easy to work with. So we always worry about landlord issues. Now, there's the price hikes, but those are also lien subordinations and personal guarantee issues. I'll be honest, I don't know if I have a solution for landlord issues, but I had to put it on the list because it's a constant cause of transaction troubles. What's been your experience with landlords and transaction issues?
So actually, a lot of what I just said about bullies and last minute concessions applies equally to landlords because
Yeah.
the normal landlord strategy when a business is being sold on their premises is that when they learn about it, they will say, do your deal and have everything buttoned down, then come talk to us. And at that point, the buyer and seller are both long committed in effort and time.
Yeah.
And now there's, a real need for the buyer and seller to make the landlord happy to approve the transfer or assignment or whatever. And the landlord now knows that they've got leverage over the deal.
Yeah.
And so my advice is always to engage with the landlord as soon as possible, and so that you can figure out if there are going to be problems with the landlord before you spend all the time, energy, effort, and professional advisors expense on doing these
Yeah.
deals. You want to know what the landlord is going to expect. And to your point of things you've mentioned, I've also seen, landlords requiring huge deposits from new people. I've seen landlords agree to an assignment where they will put the new owner onto the lease, but they won't let the old owner off. Right?
Yeah.
Like, I mean, why would you
We
have
call that
one
two
personal
parts.
guarantee when you can have two?
Yeah, yeah. Why let go of the old one? Now we have two people.
Right.
We've seen it.
And they have probably more ability to upset or influence a deal than anyone else. I've also
Yeah,
seen a lot of situations where landlords are just very ignorant about the process. And I had a client actually in California recently where it was a large corporate landlord and they had a process for new tenants. So if you wanted to start a new business, Neal, you would have to make an application. They would do a background check and credit check on yourself personally and ask you some questions about your net worth. And they basically put the buyer through that process and
yeah,
said to the buyer, you're not qualified to rent 50,000 square feet from us. And he had to go and show them that what he was doing was buying the business, and the business is what had the capacity to pay the rent. It wasn't
yeah,
him that was going to like have to come up with this rent, and he really had to teach them about what was going on, and it was simply a case of a big corporate landlord that had some turnover amongst these frontline
yeah.
employees who just had never dealt with it before, and they didn't really know how to look at or underwrite the deal. And so I think that sellers should have conversations with landlords. What is the process? What are the steps we're going to take when we find someone potentially to buy the business, to prepare the landlord? And buyers, as soon as you have an LOI, you need to get in front of the landlord and start talking to them, in my opinion.
I agree with all of that. And you make a valid point about the types of landlords. That's an early question we have. Is this a local landlord that's keeping some investment property along with something else he or she's doing, or is this some big outfit out of New York City with
Yeah.
a whole board of front end people, because that's a different landlord. It's going to take more time. They're going to be less flexible. So to understand who the landlord is, what's motivating them, and I think the answer on the sell side is to plan way in advance. If you don't have a real estate attorney that's helped you understand your lease provisions and where you're protected and what the landlord has to give you, that's something you can invest a little bit as an owner to prepare yourself, because landlords can always kill a deal. And we didn't get into bank financing and how landlords fight with the bank and the franchisor. I've been through all of that stuff too. It can be really monotonous.
And I will point this out, and if you're selling a business, you should talk to your attorney about this. But um, if for some reason you will not be able to get yourself off the lease when you're selling your business, and there's a lot of reasons for that. I mean, once you sign a lease, like it's a legal contract, the seller doesn't have to let you out of the lease, right? But the landlord may have attached your lease to some kind of financing or other contract that they are involved in, right?
Yeah.
And so they may not want to do it because they don't want to have to go and deal with unraveling the other side of whatever deal that is that they've got that they're not
Yes.
telling you about. And so if there's 6 years left in your lease, for example, and you can't get your name off, even though the buyer can get their name on, then if you're going to do some seller financing, for example, um, this can actually play to your advantage. Because if your name is still on the lease and this buyer defaults on your seller note, by having your name still on the lease, it removes any barrier from you repossessing the business and getting back in and taking over because you're
Hmm.
still on the
Hmm.
lease. Whereas if
Yeah.
you're no longer on the lease and you try to repossess the business, it means you need to come back and negotiate a new lease with the landlord to get
Yeah.
control of the premises, right?
I see. Yeah.
And so these two things can kind of work together, and you need to flesh out all of the different options and what ifs. Usually with your attorney, like to talk about what could happen under different scenarios.
Yeah.
But it isn't necessarily the end of the world if the landlord won't let you off the lease, especially if you're
Yeah.
going to do some seller financing.
I like that perspective. It's not something a lot of owners want to hear, that there's a possibility that you could be stuck to the space and even have to get your business back. They're selling to get away from the business. But if you play this whole thing out and consider just realistic, put it all on the table, there could be some solace there and in a solution if there is a problem that comes up later. Well, I love your perspectives, David. I think we solved all the problems. I don't think there's ever going to be a transaction trouble that anyone's ever going to have. Now that they've watched this video, we got
Yeah.
through them all. No, that's obviously a folly, but I enjoy these conversations with you. I want to wrap up. If people like what they've heard, they want to hear more from David C. Barnett, how the heck can they find you?
Well, they can find me on YouTube. Just look up David Barnett Small Business. Actually, on YouTube or any of the podcast platforms, you'll find me right away. I've been making videos now for 10 years, and I answer questions from people, and I do interviews and have great conversations with people like Neal here as well.
Did I hear you have a new book out?
I had a book that came out in September last year, Buying versus Starting a Small Business. And I've got a copy of it right here that came out. And so this is for people exploring entrepreneurship for the first time. But I also released an updated version of one of my longtime bestsellers, which is called 21 Stupid Things People Do When Trying to Buy a Business. And I'm in the middle of writing a new one right now, which is a
Wow.
collaboration that I'm writing with someone else. So that's a new one for me, working with another author together on a book. But that one later this spring, I should have news about that.
Love that about you. Appreciate all that you do for the small business community and your conversations. And for today, I think we're going to wrap it up there. I'm Neal Isaacs, the Raleigh business broker. You're here with David C. Barnett. Thank you for watching. Until next time, Malhala.